Trading in an E-shaped market. The global economy rarely moves in straight lines. Economic recoveries often follow recognizable patterns that analysts describe using letters such as V-shaped, U-shaped, W-shaped, or L-shaped recoveries. In recent years, economists have introduced another pattern called the E-shaped economy. This concept reflects a more complex and uneven recovery where different sectors or groups experience dramatically different outcomes during the same economic cycle. An E-shaped recovery typically appears after a sharp economic shock such as a financial crisis, pandemic, or geopolitical disruption. Instead of the entire economy recovering uniformly, some industries surge upward while others stagnate or decline further. When graphed visually, the divergent paths resemble the letter E. One line represents industries and assets experiencing strong growth, while the other lines show sectors that struggle or decline. For traders and investors, understanding the mechanics of an E-shaped economic recovery can create significant opportunities. Markets are driven by capital flows, and in a divided economy, money tends to rush aggressively toward winning sectors while abandoning weaker ones. Recognizing these patterns early allows traders to position themselves where growth and volatility intersect. The idea of an E-shaped economy gained attention following the global economic disruption triggered by the pandemic. During this period, the economic landscape split sharply between industries benefiting from digital transformation and those heavily dependent on physical interaction. Technology companies, online retailers, digital service providers, and cloud infrastructure businesses experienced explosive growth. At the same time, sectors such as travel, hospitality, commercial real estate, and traditional retail suffered deep losses and prolonged recovery periods. This divergence created a clear economic separation. Instead of a unified rebound, the economy produced multiple trajectories. Some sectors moved sharply upward, others moved sideways, and some continued downward. Economists began describing this phenomenon as E-shaped, emphasizing how unequal recoveries can reshape entire markets. To fully understand an E-shaped economy, it helps to compare it with more familiar recovery patterns. Just a quick reminder to please hit the like button and subscribe to the channel for more great content like this. Also, you can visit us on the web at investmentees.com and use the code BLOG to receive 20% off your next purchase. V-shaped recovery. A V-shaped recovery represents a quick rebound following a sharp decline. Economic activity drops rapidly but recovers just as fast. This pattern often occurs after short-term shocks where underlying economic fundamentals remain strong. U-shaped recovery. A U-shaped recovery describes a slower rebound. The economy experiences a prolonged period of weakness before gradually climbing back to previous levels. W-shaped recovery. A W-shaped recovery, sometimes called a double-dip recession, involves an initial recovery followed by another downturn before stabilization. In contrast, an E-shaped recovery reflects structural divergence. Instead of moving together, sectors separate into distinct paths. Certain industries accelerate forward while others fall behind or collapse entirely. The result is a fragmented economic landscape where opportunities and risks are dramatically uneven. Modern economies are more interconnected and technologically driven than ever before. This complexity increases the likelihood of uneven recoveries. Several factors contribute to the rise of the E-shaped economy. Rapid technological innovation often disrupts traditional industries. When economic shocks occur, companies that already rely on digital infrastructure adapt quickly, while slower industries struggle to adjust. Globalization also plays a role. Supply chains, trade networks, and digital platforms create conditions where some sectors scale globally during crises while others remain restricted by local limitations. Additionally, shifts in consumer behavior accelerate these divergences. For example, when consumers move toward online services, remote work, and digital entertainment, capital flows rapidly toward businesses capable of delivering those experiences. As a result, economic recoveries no longer move uniformly. Instead, they produce sharp winners and equally dramatic losers. Financial markets tend to amplify the patterns of an E-shaped economy. Investors constantly search for growth, and when certain sectors begin outperforming, capital floods into those areas. This creates strong momentum trends in high-growth industries. Stocks within winning sectors may rise quickly as institutional investors, hedge funds, and retail traders compete to gain exposure. Meanwhile, weaker sectors often experience declining valuations. Companies facing structural challenges may see reduced investment, lower liquidity, and shrinking market share. For traders, this divergence can create significant volatility. Price movements become more extreme as markets reprice industries based on their perceived long-term viability. Success in trading during an E-shaped recovery often depends on recognizing which sectors belong to the upward trajectory of the E. These industries typically share certain characteristics. First, they benefit from structural economic shifts rather than temporary demand. Businesses connected to digital transformation, automation, artificial intelligence, renewable energy, or cybersecurity often thrive during periods of disruption. Second, winning sectors tend to demonstrate strong earnings growth and expanding market demand. Companies within these industries frequently report increasing revenues even while broader economic conditions remain uncertain. Third, they attract institutional capital. Large investment funds prefer sectors with scalable growth potential. When institutions begin allocating capital heavily toward certain industries, the resulting momentum can drive sustained price trends. Traders who monitor these patterns can align themselves with sectors benefiting from the positive side of the E-shaped recovery. Just as important as identifying winners is recognizing industries on the downward side of the E-shaped economy. These sectors often face structural challenges that prevent rapid recovery. For example, businesses heavily dependent on physical infrastructure, traditional retail models, or outdated technology may struggle to compete in an evolving economic environment. Investors frequently reduce exposure to these industries as future growth prospects decline. This leads to falling valuations, reduced liquidity, and increased market pessimism. For traders, these sectors may still present opportunities through short selling, options strategies, or sector rotation trades. However, they require careful risk management due to sudden policy changes or unexpected rebounds. Profiting during an E-shaped economic recovery requires a flexible and adaptive trading approach. Instead of assuming that the entire market will rise together, traders must focus on relative performance. One effective strategy involves sector rotation analysis. By tracking capital flows between industries, traders can identify which sectors are gaining momentum and which are losing investor interest. Momentum trading can also be highly effective during E-shaped recoveries. When capital concentrates in winning sectors, price trends often accelerate. Traders who enter positions early in these trends can benefit from sustained upward movement. Another approach involves pair trading, where investors simultaneously go long on strong sectors and short weaker ones. This strategy attempts to profit from the widening performance gap between industries. Risk management remains essential. Divergent economies often produce sudden volatility spikes as market sentiment shifts. Understanding the broader economic environment helps traders anticipate how an E-shaped recovery might evolve. Key indicators such as employment data, consumer spending, inflation trends, and central bank policies can influence which sectors thrive. For example, low interest rates often support growth industries by making capital cheaper and encouraging investment. Fiscal stimulus programs can also reshape sector performance. Government spending on infrastructure, green energy, or technology initiatives can rapidly accelerate growth in specific industries. Traders who combine macro analysis with sector-level insights gain a deeper understanding of how capital flows within an E-shaped economy. An often overlooked aspect of the E-shaped economy is its psychological impact on investors. When some sectors rise rapidly while others collapse, market sentiment becomes polarized. Investors may develop FOMO, fear of missing out toward high-growth industries, pushing valuations higher. At the same time, pessimism surrounding declining sectors may drive prices below intrinsic value. Successful traders maintain emotional discipline during these periods. Instead of reacting to hype or panic, they focus on data, earnings performance, and macroeconomic trends. Maintaining a balanced perspective allows traders to identify genuine opportunities rather than chasing short-term market excitement. An E-shaped economic recovery often signals deeper structural changes within the economy. Industries on the upward trajectory frequently represent the future direction of economic development. Technological innovation, digital infrastructure, and evolving consumer preferences reshape how businesses operate and generate revenue. Over time, the gap between thriving and declining sectors may widen further. For traders and investors, this transformation highlights the importance of continuous market analysis. Economic shifts rarely happen overnight, but once momentum builds, they can redefine entire investment landscapes. Recognizing these patterns early provides a powerful advantage in navigating modern financial markets. Conclusion: the concept of an E-shaped economy reflects a reality increasingly visible in modern markets. Economic recoveries are rarely uniform. Instead of rising together, industries often diverge dramatically following major disruptions. Some sectors surge ahead, fueled by technological change and shifting consumer behavior, while others struggle to adapt. For traders, this environment creates both challenges and opportunities. Profiting from an E-shaped recovery requires understanding how capital flows between industries, identifying sectors benefiting from structural growth, and managing risks associated with volatility and market sentiment. By focusing on sector momentum, macroeconomic indicators, and long-term structural trends, traders can position themselves on the upward trajectory of the economic E in a divided economic landscape. Success belongs to those who recognize where growth is accelerating and act decisively before the broader market catches up. Thank you for watching.